The year of 2019 was a year of dissonance. Economic growth and equities reflected a clear disunion in their performance in 2019. GDP clearly witnessed a slowdown in growth, while the Nifty is at all-time highs. It's come off a little now, but it's still at highs. Even within equities, polarization was clearly visible, with select large caps ruling the roost and broader markets witnessing a dry spell. Joining me now to talk about what 2020 as a year could look like and lots more is Nandita Parker. She's a managing partner at Capital Management. Nandita, great to have you. Thank you very much for taking out the time and joining me in this special conversation. So let me start off with that, since we introduced it in that fashion. 2019 was a year that probably you could put in the back burner in hopes that 2020 will turn out to be better for equities. Nonetheless, the index did hit fresh life highs. Do you feel that 2020 as a year could be any different? Say, for example, even the fact that mid caps and small caps can start to outperform versus the polarization that we witnessed in 2019.
Yeah, I think, Davina, we're certainly starting with that. Since the beginning of the year, there has been a sharp revival in the fortunes of the small and mid-cap stocks, and I expect to see that trend continue for the rest of the year as well. There are a number of hurdles we need to cross before we paint a very sanguine outlook for the economy. But it looks like the government is now fully informed of the challenges that lie ahead for economic growth to pick up. Some of these have been outlined by now the business houses. Some of these have to do with taxation. Some of these have to do with regulation, micromanagement, over-regulation, uncertainty. All of that needs to be addressed. Let's step back and recall the time when India used to be at the top of the totem pole of emerging markets when it came to attractiveness. And even though today it seems like distant memory, I think there's a lot that can be done to regain that top spot. And I'm looking forward to this budget that will be presented by the government on February 1st to lay out a roadmap of how investor confidence will be regained, how business confidence will be regained, and how consumer confidence will be regained. So it's a triple challenge to the government. And a lot for them to work on, and I believe that they have been talking to various stakeholders in the past few weeks and months. We have also put forth our proposals, and if you like, I can take you through that right now.
Right. In fact, that was going to be my very next question. It's in fact been, a growth-challenged environment, and as recent as last night, we heard the fact that IMF is talking about a growth forecast of 4.8% for India. So it's a real big challenge for the government now as to what innovative tools and measures they can come out within the budget to make sure that the demand that has been suffering because of the growth that has been crippled so far gets corrected. So, what do you think could be the measures that could be adopted by the government?
Right. So a couple of things from my standpoint. I mean, one, of course, is spending on infrastructure. And very particularly, I want to focus on something which is not very much talked about here in India, is the impact of climate change. So India needs to build all of the infrastructure possible to fortify itself from the negative impact of climate change and from natural disasters, which seem to be going around the world, starting from the California fires to all the way to Australia, and the devastating effect of floods, fires, changing of river courses, the melting of the third pole, which is which is right here, Mount Everest. And these kinds of things have to really come into the conversation. Businesses have to plan for it, and government has to plan for it. And so the government has announced a very large infrastructure spend plan for the next 5 years, more than $1 trillion. It's 50% higher than how much they spent in the past 5 years. And really what needs to happen is we need to plan for the next 10 years and focus a lot more in reduction of carbon emissions, in a reduction in pollution, in actually taking carbon out of the equation, and so on. So this is one big area. From our standpoint, we're focusing a lot more on companies which are helping the environment, whether it's reducing their helping other companies reduce their carbon footprint, green energy, wastewater treatment, sewage treatment, and so on. So that's one big area of focus for us. The other thing I'd like to point out is not just us, but the bulk of investing globally is now driven by ESG investing. 38% of global flows are going into ESG focused type of companies. So this is a very big area that the government can tap into for not just FII but also FDI into India. But this is a long-term situation that we need to address right away. The second aspect that I want to talk about and the ask from industry is two things on taxation. One is reduction, one is going away, the removal of capital gains tax, long-term capital gains tax, which is acting as a hurdle for foreign portfolio investments into India. And this would bring India in line with global norms. Only 2 countries in the world tax foreign residents on for the transfer of share of securities. So that's the number one ask. And that would make a very big impact on market sentiment. It will make a very big impact on foreign investor sentiment. And this can be offset partially by a marginal increase in STT if required. But I also believe that the positive effects just of long-term capital gains tax going away on the cost of capital of India, on dollar inflows into India will really offset any cost side impact. The second ask, which is another very big one, is to allow foreign funds, offshore funds, to move their operations into India and run out of India. And this is a huge area where it can create 100,000 new jobs. It can create billions of dollars of tax revenues for the government, and it's acting as a hurdle for foreign investment. So these are the two things that I'm looking out for. I know that industry is also looking for the dividend distribution tax going to zero and shifting dividend distribution tax from the company level to the individual level, or to be taxed in the hands of the person who gets dividends. And what this would do is remove some of the distortions that exist in the capital structure and capital allocation when companies make their decisions. So this is another area that we think would be very important to be addressed in this budget. So I think that from a government standpoint, they have really multiple challenges to face.
Yeah.
But I think this is the time to take some bold actions and bold
Indeed.
measures and take cognizance of the issues that investors are facing.
Right. So while keeping these in mind from the industry standpoint, if you have to look at what the government has done so far, I mean, we've all, taken into cognizance that the government has been listening and, they're addressing the supply side issues. But what could they really do to make sure that consumption comes back on track and address the industry-wide demand shortfall that we're currently seeing? And do you think that's going to remain a bigger challenge?
So one of the things that we keep hearing from, as we talk to companies and businesses, is that the government needs to pay its bills. It needs to pay states the central government needs to pay states what it owes, the dues of the states, and the state governments need to pay its vendors and suppliers and contractors and so on the dues. So this is something that will bring liquidity back in the hands of developers, project developers, infrastructure companies, and so on, and in the hands. So while there is plenty of liquidity at the banking system, the liquidity is not reaching the last mile. So these are some of the things that need to happen.
2020, according to you, Nandita, do you feel that it's going to be a year of earnings improvement? I mean, we've seen valuations of certain segments soar really high. India as a market is still not cheap. We're trading at record high levels, even compared to the other emerging markets. Corporate earnings, however, have been lagging. Do you see 2020 change that?
Yeah, I would hope so, because the past 5 years have been very disappointing for corporate earnings in India, and this is for the broad base. This year, we're going to see a recovery in the banking system in terms of earnings growth as a result of reduction in the whole NPL cycle and right back. So I think the positive impact of IBC and bad loan resolution is coming into the fore where the banking system is concerned. Secondly, we're going to see an upsurge in earnings of the telecom operators. These may not be the best thing for consumers, because the sharp increases in tariffs are certainly not going to benefit the consumer. But from an earnings growth perspective, yes, this is certainly coming back. Thirdly, we're going to see an increase in some of the commodity sector earnings across the board from steel. We're seeing price hikes in steel. We're seeing some pricing power return to cement. Let's see how long that sustains and whether it sustains post-monsoon. But based on the infrastructure spending announced by the government, it seems to me that from the commodity end as well, India is going to see some benefit. So a lot of these old economy type plays are going to come back and start looking more interesting from an investment standpoint.
Which is actually going to be my next question. You know, we've seen asset-heavy industries, particularly on the index, the likes of energy, metals, auto, being a clear underperformers versus the services and even the financials, like we spoke about. Even IT, for that matter, seems to be doing okay for itself. Do you see that as a trend continuing, or for that matter, asset-heavy industries could turn the cornerstone?
Right. So we tend to not be bullish on the automobile industry for a number of reasons. But other than that, the rest, infrastructure-related industries, companies that are focused on sewage treatment, wastewater treatment, decarbonization, biomass, waste to energy, clean energy, anything to do with the environment, I think we're very bullish on, and we're expecting a change there. We also think that particularly with the global focus on plastics pollution of the rivers as well as oceans, this is becoming a big issue, and a switch over to paper packaging is a very important global trend that we're seeing. And so I think India as well has a number of paper companies, so they should see some amount of interest. So yeah, there is a lot more to choose from today as a result of the very large valuation gap that what has existed in the past. But let's wait and see what the budget brings out, and whether it will attract the 25 to 35 billion dollar type of FII investment that India has the potential of bringing in.
Yeah, potential which we've not been able to tap in for some time now, Nandita. And that was something that I wanted to talk to you about. FIIs looking for growth. of late are not going to be able to find that in India. Now, with they're talking about a GDP growth of 4.8%, most of foreign brokerages are talking about North Asia as a pocket where much of the money is starting to flow. So what do you think will interest them to come to Indian shores and invest?
Right. So I think if the government takes very credible steps to address some of the concerns of foreign investors. When it comes to growth, as we talked about, spending on infrastructure, addressing the taxation challenges that companies are facing, removing tax uncertainty, removing regulatory hurdles, making the environment a lot more predictable. So I think when it comes to risk capital, capital is looking for risk reward in a different way today. And India needs to take cognizance of the fact that there are lots of places to choose from. And in order to regain its top spot on the totem pole, it really needs to make these big policy shifts. And I'm pretty sure that if it does, it will be rewarded, and we can see, the next 5 years can be the start of a very interesting super cycle of investment in India.
Right. The government came out with corporate tax cuts, which really helped the bottom line of all of the companies. Expectations are that you may actually end up seeing something with regards to the personal tax in the budget as well, which could leave more money in the hands of consumer, which again could be used to spur the consumption cycle. Are you expecting anything of that sort?
I mean, it's hard to say, so let's just wait and see.
All right. The other bit is, what do you think could be a disruptor from the global front? We've shrugged off trade tensions for now. We've got the first deal that's been signed. Geopolitical risks, you saw the initial knee-jerk reaction that global equity markets had with regards to Iran and the US. But now things seems to have stabilized a bit more. Do you feel there could be any other disruptors with regards to global market uncertainty?
So I think the US is going to be a very interesting space to watch, especially given that this is a presidential election year. And if there are some interesting candidates on the Democrat side and their ability to challenge President Trump, I mean, that could be a very interesting space that the markets are probably not pricing in right now. So depending on who the Democratic candidate is, we can have some volatility in the markets in the middle of the year. So that's one space to look out for. Secondly, U.S. recession. The expansion has gone on for a decade, and a lot of economists have stopped predicting when the U.S. recession might hit and what magnitude it might be. So that's something that could be, somewhere down the line. It could be a 2021 type of event and something not to be considered this year. And also its impact on emerging markets now remains to be seen, because today the emerging markets are in much better shape than they were last time around. So as I said, I think the biggest challenge could be this volatility related also to climate change. And these events are very hard to predict, but there's certainly something to look out for.
Does it worry you that the last decade of a bull run that we've seen for the US equity markets has come back on the back of easy and cheap liquidity provided by the central bank, and it doesn't look like that they're going to hold back anytime soon as well, and so is the case with most other central banks which are pumping in liquidity into the system, and that's finding its way into the equity markets with no clear substantial improvement in fundamentals. So is that a worry?
So I think that all rallies are led by liquidity. This is not a new thing, and excess liquidity can also lead economic activity. So one thing can lead to another. I mean, in India, clearly the lack of liquidity was a big factor in choking off economic growth in the past 2 years. So if banks are flush with liquidity today, and we get in India large amounts of inflows, FDI as well as FII, that certainly can lead an economic recovery. So I'm not so concerned about that.
Are you increasing exposures to any specific sectors in Indian equities, Nandita?
So as we mentioned, we are focusing more and more on the E of ESG investing. So yeah, we are focusing on companies that are decarbonizing, helping other companies decarbonize, reduce their water consumption, so increase efficiency in their processes, reduce energy consumpme, and as well as paper. So these are our areas of focus. I think that one of the things to look at is that India is now producing 7,000 startups a year, and this is a very exciting space to watch. And over time, these will come into the listed space as well. So that's another area that will grow.
All right, the choice just keeps getting wider. Just one last question, Nandita, before we wind down this interview. The most recent spate of events with regards to the coronavirus and its impact that it's having in the Asian markets right now. I mean, there are talks of the possibility of Asian-focused funds pulling out on the back of this particular issue. Do you see that having a bigger impact?
Well, it's really hard to say. Depends on the type of travel advisories that are put out, depends on the amount of screening that happens. One good thing that I see, but I don't know if it's exactly true yet, is that this is not the deadliest of viruses. So it doesn't have the high fatality rates that we've seen with Ebola. But if you look at the impact of SARS way back in almost 20 years ago, there was a very big impact in China in terms of GDP growth and Hong Kong. And to the extent that this is emanating from China, there can be an impact, but it's really too early to say. I would think that it does impact the travel industry, and there would be a reduction in any kind of discretionary travel. But really, we have to see what type of advisories and screening measures are put out by the authorities.
Indeed. Great. Nandita, this was an absolute pleasure. Thank you so much for joining in on this discussion.
Thank you.
Nandita Parker there, managing partner at Karma Capital, talking about a whole host of things, including her outlook for 2020. Where is the focus of Karma Capital in terms of Indian equity market investment as well? Thanks a lot for watching.